Alright, so we're looking at chapter 9, basically dealing with receivables, accounting for receivables, I think it's called. I've started on this page because this is really the main thing that you're going to look at is this idea of uncollectible accounts. Previously it talked about, three types of receivables: accounts receivable, notes receivable, and other receivables. And then within those, you've got recognizing, valuing, and disposing. So, I don't think there's many questions there. The ones about recognizing accounts receivable is just the notations you've been using when you post things, write a journal entry or post things to Ledger and things like that. There's nothing changed there. It's where you get into this idea of you're not going to get the money. Right, so every business has that point where they either plan ahead or they react real time to when they're not going to receive the money for their services or for their products or whatever it is. So it'd be interesting actually to learn how, in your experience, if you have any in that or somebody how they do it. But the two methods looking at is the allowance method and the direct write-off method. So the first one they look at is the direct write-off method, and basically that just says that as soon as it's determined that so and so in this case this Schaefer guy, he's a deadbeat, he's not going to pay his bill for whatever reason. So as soon as that happens, they enter this write-off. Meaning they expense it to an expense account called bad debts, and they take it out of accounts receivable because they're not gonna get that money. Okay, so that's the direct write-off method. And to go along with that, right? They don't have any matching the bad debts to the specific revenue. When they do that on the balance sheet, so there's no balance to that part of it, but it is a real-time transaction. I think, yeah, a real-time transaction that would just get rid of, not get rid of, but basically immediately strike off from the moment that they know that the money's not going to come in. So that's just an immediate part. The other one, the allowance method, is basically thinking year over year, there's going to be a certain amount of money that they know that they're not going to get, and they're going to allow for that amount of loss at some point in their accounting period. So whether it's a yearly basis or monthly or a 6-month or whatever it is. So they're going to take into account, now it could be from years past in their own business, or they could be taking it from, if they're a new business or just the way they do it, they might take it from like an industry standard, looking at other industry numbers. And this is matched up with sales. So they take a percentage of the sales and they say, we're not going to, for whatever reason, get all the money from the sales that we record, so we're going to start by having bad debts expense against allowance for doubtful accounts. So those are the two different methods that you can use. You can see they're both expensed to an expense account called bad debts. The other one, if you remember, is directly off of the books of the accounts receivable of whoever's not paying the bill. This one, the credit goes to an account called allowance for doubtful accounts, and that basically means that they don't think they're going to get this much money. It's not particular to that one account. It's particular to all accounts based on a percentage of sales. It could say 2% of sales over a year period. They're not going to get that money, so they're going to look at it as in we're going to plan ahead, and we know what 2% is not going to come in, so that's where this idea of allowance for doubtful accounts comes from. It is a contra asset account, okay, so it should be dealt with accordingly. Okay, let's see. So I'm going to skip forward here as they have. So there's the example of allowance for doubtful accounts. So this is where they've gone from, they already have the allowance for doubtful accounts, so they've already said, 2% is not going to be collected. This is a particular person, so this Nadeau is not going to pay his account, so now they're going to finish the write-off method. Not write-off method, they're going to finish their credit method. Not the word I wanted to use. Their method of dealing with accounts that are going to be uncollectible. I guess it's the safe way to say it so it's not confusing. Basically, so this Nadeau can't pay, so it comes out of the accounts receivable because he's not going to give them the money, and it gets debited against that contra asset account called allowance for doubtful accounts, which is already in the previous has been loaded, if you will, or has been reported as a percentage of the sales that they don't think they're going to get, right? So it's been expensed already, and now this is a particular account that's now being dealt with. Now, what happens when someone actually does pay their bill? By the way, these numbers, the red numbers should be in the credit side. I don't know why when you convert these things over, like that one works fine. That one doesn't. I don't know why. It should be over in the credit side. Anyway, yeah, so 500 debit for allowance for doubtful accounts. Accounts receivable should be credited at 500. Not really sure what's going on there. So, what happens when somebody comes in? What happens when somebody comes in and they're actually going to pay their bill, right? So they think, oh, it's not going to happen. They're not going to pay, and they've allowed for that money under the one we just said. What happens when you have to reverse the transaction? Okay, so reversing the transaction is, obviously just doing the opposite that the previous transaction had done. So you're putting the money back to the accounts receivable from the allowance for doubtful accounts. So you have to do that first, and then you do it as a normal transaction. The cash that is received, however, the method of payment is cash, and then debiting or crediting the accounts receivable. So you have to do the first step first, then you do the actual transaction. You can't just do the transaction because technically the money has already been accounted for from accounts receivable by the bad debts expense through the allowance for doubtful accounts. So you have to reverse that transaction first, then you do the regular transaction. Okay, so two ways of looking at it: percentage of sales or percentage of receivables. So sales is obviously a revenue based, so we'll be looking at I think it goes on the next slide here. So the one is looking at the percentage of sales being bad debts expense. Okay, so that's an income statement relationship. Then the percentage of receivables is a balance sheet relationship. So you're looking at percentage of sales bad debts expense. That is looking at exactly, matching it to your revenue. And then the other one is the actual amount of money, not the sales part, but the actual money that is owed. So that would not take into account cash transactions or cash value, things like that. This is just money that's going to be due later that they don't think is going to come in. Okay, so there are two ways to actually look at that based on a number of different things. It's not, one's right and one's wrong. It's the choice of management in that way. Okay, so whichever one they think is more accurate or whichever one serves their purpose, that's the one that they're going to better, or not, that they're going to choose to use. The percentage of sales one, right, that makes a match better between expenses and revenues, but again, it's not necessary. The other one, right, just takes out the sales that are basically already through, because if somebody gives you cash or a cash equivalent, they're probably not going to be reversing that. So you could think of it as the receivables is just based on money that you actually may not get back. Yeah, and then the rest of it, the credit card and bank card sales, wouldn't worry too much about that. Just look at the review, but those things are a little antiquated at this point. Just considering all the different payment methods now have changed since this book was written. So, but yeah, okay, if you have any questions, then let me know. Thanks. Bye-bye.